Okay, we are going to jump now into chapter 25, differential analysis and product pricing. So the first exercise that I have here is number 1, differential analysis. Burlington is considering selling excess machinery with a book value of $115,000 cost and accumulated for 90 grand, less a 6% brokerage commission. Alternatively, the machine could be leased for a total of $100,000 for 4 years, after which it is expected to have no residual value. During the period of the lease, Burlington costs of repairs, insurance, and property taxes are expected to be 9 grand. So it says prepare a differential analysis. So we're going to compare the two alternatives, 1 and 2. So underneath alternative 1, if you say that that's leasing the machine, we're going to get 100 grand for it. We'll have 9,000 of expense. We're looking at 91 grand. If we sell the machine, we're going to get 90 grand for it. We have a $5,400 brokerage commission, so there's an $84,600. So the difference between the two is a $6,400 difference. So letter B, it says, B, on the basis of the data, would it be advisable to lease or sell? From a pure dollar standpoint, no other factors, leasing is probably the better route. Number 3, differential analysis for a discontinued product. A condensed income statement by product line for this beverage company indicated the following for Mango Cola for this past year. It is estimated that 30% of the cost of goods sold represents fixed overhead and 25% of the operating expenses are fixed. That is something that we need to identify. Because Mango Cola is only one of the many products, the fixed costs will not be materially affected if the product is discontinued. So if you notice, this right here is exactly what's in your textbook. That's as if we're going to continue to do it. So if we don't have that, we won't, of course, have the revenues. We certainly won't have the variable costs, but we still will have fixed costs, right? We're going to have the cost of goods sold, 30% of that, which is right here, as well as 25% of the operating expenses. So you calculate that, and we're going to still have fixed. Those fixed costs are going to be there regardless if we continue or discontinue. So looking at it this way, we lose less by maintaining it than if we were just to be done with it. And that's usually not the answer everybody is hoping to see or wanting to see or even probably had no idea. But at least it covers some of those fixed costs. Number 6 is the next one we're going to move to, and it's called decision to discontinue a product. So on the basis of the following data, the general manager of Hawkeye Shoes decided to discontinue children's shoes because it reduced operating income by $30,000. And if you look at just the income statement there by product line, it appears as if we're losing 30 grand. However, that's not the whole story. The question is, what is the flaw? Well, the flaw is if we get rid of it, this number right here is still there. So there is an obvious differential effect there. The reason they want to keep it, we're still losing 30 grand as far as operating income is concerned, but it's covering some of those fixed costs of 75. We get rid of all of this, we're going to have a much greater loss. The next one I'd like to look at is number 7. It says make or buy. Somerset Computer Company has been purchasing carrying cases for its portable computers at a purchase price of $24 per unit. The company, which is currently operating below full capacity, that's important, charges factory overhead to production at a rate of 40% of direct labor costs. The unit costs to produce comparable carrying cases are expected to be as follows. Direct materials, direct labor, overhead, If Somerset Computer Company manufactures the carrying cases, fixed factory overhead costs will not increase, and variable factory overhead costs associated with the cases are expected to be 25% of the direct labor. All right, so it says prepare a differential. So if we are making those cases, as it shows there, right there in the text, it would cost $24.80. If we were to buy them, if we were to purchase them, there is a $24 cost. However, there is still $1.80 in fixed overhead, which is the $12 of direct labor times the 25%. So we will still have this, oh, excuse me, I take that back. Here, this variable factory overhead right here. If we take the $12, as it says in the book, the $12 of direct labor and take that times the 25%, that is the variable factory overhead. And then the fixed factory overhead is the difference, because the total was $4.80. The total overhead was $4.80. And they're saying, okay, take away 3 of it, and that's the variable, which leaves us with $1.80 of fixed. I apologize. So that $1.80 is going to be there regardless. It's the 3 that would go away. So in total, we're looking at $24.80 versus $25.80. So again, it would make more sense for us to buy them. We still have that fixed overhead in place. Number 9 reads machine replacement decision. A company is considering replacing an old piece of machinery which costs $400,000 and has $175,000 of accumulated depreciation today, with a new machine that has a purchase price of $550,000. The old machine could be sold for $250,000. The annual variable production cost associated with the old machine is estimated to be $72,500 for 8 years. For the new machine, we're looking at $24,000 for 8 years. Prepare a differential analysis. So for number 9, if we continue with the old, we have the variable production costs, which is the $72,500 times 8. If we replace and go with the new, we're going to get proceeds from the old, $250,000. We have to purchase the new one for $550,000. But this new $24,000 times 8 is what goes up here in the $192,000. So when it's all said and done, it's going to cost us less per year with the new machine. So the company should replace the new machine. Letter B is an important question. What is the sunk cost? The sunk cost is right here. It's the cost, and we got some accumulated depreciation. This book value number is sunk. It should not be considered in the decision process. It's hard to have some people let that go, but it's done, it's gone. We can't do anything about that. Number 11, this lumber company incurs a cost of $315 per 100 board feet in processing certain rough cut lumber, which it sells for $440. An alternative is to produce a finished cut at a total processing cost of $465, which then can be sold for $600. Prepare a differential analysis on whether to sell rough cut or process further. So they get it for $440. It costs $315, $125. If they process it further, it can now be sold for $600. There is a new cost of $465 for a difference of $135 per 100 board feet. So should they process? They should process and sell the finished cut lumber. Number 13, decision on accepting additional business. Homestead Jeans has an annual plant capacity of 65,000 units and current production is 45,000. So we're below. That makes a big deal. Monthly fixed costs are $54,000. Variable costs are $29 per unit. The present selling price is $42 per unit. On November 12th of the current year, the company received an offer from Dawkins for 18,000 units of the product at $32 each. Still within that capacity. Dawkins Company will market the units in a foreign country under its own brand name. The additional business is not expected to affect the domestic selling price or quantity of sales. That's huge too. Prepare a differential analysis. Well, they reject the order. Of course, there's nothing, right? If they accept it, they are going to get 18,000 units times 32, or 576,000, and 18,000 units at a cost of $29 per unit leaves them with $54,000. So it makes sense to go for it, do it. And then the most important question is, what is the minimum? I'm not sure it's the most important, but it's an important one. What is the minimum price? Well, the minimum price before we would accept it. Well, if the cost is $29, we need to get something just slightly north of that in order to accept it. So in this case, it just says, 1 penny over that, and then there would be a positive contribution margin. Of course, you want to do more than that, but that's as low as you could go. Number 14, accepting business at a special price. Box Elder Power Company expects to operate at 85%. The total manufacturing costs for May for the production of 40,000 batteries are as follows. The company has an opportunity to submit a bid for 5,000 batteries to be delivered by May 31st to a government agency. If the contract is obtained, it is anticipated that the additional capacity will not interfere with normal production or increase the selling or administrative expenses. What is the unit cost below which Box Elder Company should not go in bidding this contract? Well, in the text there it says it's $522,000 worth of manufacturing costs. There is fixed overhead of $150,000, so that is really what we would call our variable costs. If they're going to produce 40,000 batteries, that's what's projected in that total manufacturing cost budget. We're looking at $9.30. The lowest bid is $9.30. And let's keep in mind, $9.30 is a break even. So the lowest bid should be sufficient to cover the variable costs at $9.30. We will stop there at this time, and then we will finish the rest of chapter 25 in the next video. But at this time, I would ask that you re-review what we just covered, making sure you understand the exercises that are assigned.